Graceman Knowledge of GMK. Welcome to my YouTube channel, where you are taught all you need to know about accounting, finance, and lots more. Remember to like, share, and subscribe.
Welcome to Graceman Knowledge of. The previous episodes, we did emphasize in the first episode the objective of IAS 16. We said that the objective of IAS 16 is the accounting treatment of property, plant, and equipment with respect to the declaration and presentation in the financial statement, and with emphasis on the carrying amount, depreciation, the payment losses, and the cost recognition. So in this episode, we're talking about depreciation and revaluation. How does revaluation affect depreciation? When a property, plant, and equipment is revalued, what is the effect on the accumulated depreciation, and what is the effect on the future depreciation of same assets? At valuation, the accumulated depreciation as at the date of valuation will be debited to the accumulated depreciation. Why will it be debited? To be debited because it is assumed that the asset is newly purchased, and for future accounting treatment, it is better to debit the accumulated depreciation so that the depreciation on the asset can be computed to the future. This is also to avoid the overstatement or understatement of the accumulated depreciation and the net book value or carrying amount of the asset. If the accumulated depreciation is not debited, it will simply mean that the accumulated depreciation is overstated with an asset that has been revalued and with new depreciation value. And eventually, when this asset is to be recognized, the previous accumulated depreciation on the asset prior to the revaluation will not be taken into consideration. So it's always advisable to debit the accumulated depreciation at the date of revaluation so as to avoid overstatement of the accumulated depreciation and understatement of the non-current, understatement of the net book value or the carrying amount. Also at valuation, the depreciation amount changes. Why does it change? It changes because it's either revaluation surplus or deficit. So in a situation where it's revaluation surplus, what happens to the depreciation? Depreciation increases. Other things being equal. What is constant here? It also do happen that when there is valuation surplus, the useful life can also increase. In a situation where the useful life increase with valuation surplus, that will mean that the depreciation will reduce, and the reduction will be to the magnitude of the increase in useful life with respect to the revaluation surplus. And when there is valuation deficit, the depreciation will reduce. Looking at illustration 1, a company purchased a building on the 1st of April 2001. The cost of the building $100,000 on the 1st of April 2001. The assets had a useful life of 40 years. Useful life of 40 years. On the 1st of April 2003, the company revalued the building to the current fair value of $120,000, revaluation amount of $120,000. After how many years? 2001, 2003. After 2 years. That simply means that the depreciation per year is 2,000. So the formula for depreciation using a straight line approach will be 100,000 naira minus scrap value of 0 divided by 40 years. That will give us 100,000 naira divided by 40. That will give us 2,500 per year. And they said that the useful life is 40 years, and the asset was bought on the 1st of April 2001 and revalued on the on the 1st of April 2002. That simply means that they accumulated depreciation on the day of revaluation is 5,000 naira. Now, what is the formula for carrying amount? Formula for carrying amount is what? Is cost minus what? Accumulated depreciation. What is the cost? 100,000 naira. What's the accumulated depreciation? 5,000 naira. So our carrying amount is what? 95,000 naira. Now, how do we get the revaluation? How do we know whether it's revaluation surplus or revaluation deficit? Now, revaluation surplus is what? What's our revaluation amount? $120,000 minus carrying amount of 95,000. What is the revaluation surplus? $25,000. This is our revaluation surplus. So what are we going to debit to the non-current asset to show the increase in the value of the asset? Now the revaluation amount is 120,000 naira, and the historical cost of the asset is 100,000 naira. The difference between the two is what? $20,000. So this means that this will be debited to the non-current asset, which will be an addition to 200,000 to make the new revaluation amount. So what will be the accounting entry? We will debit the non-current asset with $20,000. We will credit our revaluation reserve with $25,000. Knowing fully well that at the date of revaluation, the accumulated depreciation was $5,000. What do? We debit the accumulated depreciation with $5,000. So what will now be depreciation after the revaluation? Then after the revaluation will now be depreciation after revaluation date. We know well that 2 years have already been spent, so we have 40 years minus 2 years. So that means the remaining useful life of the building is what? 38 years. And the new revaluation amount is what? $120,000 divided by 38 years. So these are new revalued amount, and this is the remaining useful life. That will give us $3,157.89. So this will be the new depreciation rate, the depreciation amount after the revaluation. And this is the accounting treatment, and this will be the new depreciation amount after revaluation. And this is the case of what? Revaluation surplus. So this is the implication of valuation surplus of both the accumulated depreciation and the future depreciation based on the useful life of the asset, the main useful life of the asset, and also based on the revaluation amount. Going to the second question. A company purchased a building on the 1st of April 2001 for $100,000. At which point it was considered to have a useful life of 40 years. At the end of 31st March 2006, it was revalued for $98,000. How will the building be accounted for in the year ended 31st March 2006? Now, we know that the revaluation, this is the revaluation amount. How do we arrive at the carrying amount? carrying amount will be the cost less the accumulated depreciation. So how do we know the accumulated depreciation? Depreciation amount equals to 100,000 divided by 40 years. That means the annual depreciation will be 2,500. So if the annual depreciation is 2,500, 2002, 3, 4, 5, 6. That means at the end of 2006, it has spent 5 years. So accumulated depreciation after 5 years will be 2,500 multiplied by 5, and that will give us 12,500. That's the accumulated depreciation. So what is the carrying amount as at the end of 2006? The carrying amount will be, is cost minus accumulated depreciation, and this will be 100,000 minus 12,500. This will give us 87,500. Now, if this will give us 87,500, we know well that the revaluation surplus will be the revaluation amount minus the carrying amount. What's the revaluation amount? The revaluation amount is $98,000 minus carrying amount of $87,500, and that will give us $10,500. So having that as $10,500, what will now be the accounting entry? The accounting entry will credit our revaluation reserve with $10,500. We will debit the accumulated depreciation, knowing fully well that this will have new depreciation amount because of the revaluation amount. We will debit the accumulated depreciation with the accumulated depreciation amount of $12,500. Because it's a revaluation deficit, what do? We will credit our NCA with a revaluation deficit of $2,000, which is the difference between the revaluation amount minus the historical cost. Revaluation amount is $98,000 minus $100,000. That means from the beginning of 2007, the cost in the books will now be $98,000 divided by 35 years. This is the depreciation amount after revaluation will be $2,800. Thank you so much for watching. Do not forget to like, share, and subscribe.